Well, Kelly, thanks for joining us today. We're really excited to have this conversation together. You recently wrote an article called Can the Market Multiply and Divide? Non-Proportional Thinking in Financial Market. That sounds really interesting. Can you explain to us what non-proportional thinking means?
Sure. So proportional thinking means thinking in percents or proportions, and non-proportional thinking means thinking in dollar units. Now, investors in financial markets, they should always be thinking in percents or return units. And that's because the share price of a financial security, well, that has no inherent meaning. It's simply how many shares a stock is divided into. That will determine the share price. Now, why might investors start thinking in dollars when they shouldn't? Well, it's because media outlets such as the Wall Street Journal have historically always reported only the dollar price in share movements relative to the previous day. And modern iPhone apps, for example, only show the daily price change by default, and you actually have to go into settings and turn on return units. Now, to see how non-proportional thinking can then distort financial returns, let's consider two otherwise identical stocks. One is just $20 per share, and the other is $30 per share. So the $20 per share stock is simply divided into more shares, which is why it has a lower share price. Now, suppose investors engage in non-proportional thinking, and a piece of news arrives, such as the arrival of a new CEO who is known to be skilled. Now, what should happen is both the $20 stock and the $30 stock, they go up in value by the same percentage return. But if investors think in dollar units, they might reason that both stocks should go up in value by $1 each. This leads to a return overreaction for the lower price stock, because a return is just $1 divided by the share price. And it's also going to lead to return underreaction for the higher price stock. And all of this is going to lead to mispricing in financial markets.
Can you talk us through some of those implications? You're talking about underreaction, overreaction. It sounds like some of it has to do with volatility.
Sure. So non-proportional thinking, so if investors react to news in dollars, it leads to greater return reactions to news for lower price stocks. And that then translates into higher return volatility for these lower price stocks and lower return volatility for higher price stocks. The same predictions actually apply to measures of market beta. Let's suppose there's aggregate market news and investors react to that news again in dollar units, then the lower price stock is going to move too much with the market, leading to a higher beta. And that is what we find in the data. So all else equal, lower price stocks have much higher volatility as well as market beta. And the cleanest evidence of this is right after a stock split. So after a stock split, nothing fundamental about the stock changes, but its share price is half of what it was before. If investors react in the same dollar units to news as they did before, then the return reactions are going to be too big. And that's what we observe. So right after a stock split, the day after, volatility is 20 to 30% higher than it used to be. Beta is also higher by about 30%, and it stays higher for the next 6 to 1 year after the split.
That seems related, though not identical, to what we know about small cap companies. Can you kind of make the link and where the connection may not be completely valid?
So it is well known that small cap stocks have higher volatility and market beta. Has led many investors to believe that maybe size is a fundamental determinant of risk as measured by volatility or beta. And what we show is that size is actually not a fundamental determinant of risk. It's actually all due to the correlation between size and price. So if we were to hold price constant and vary size, we find no changes in volatility or beta in the data. On the other hand, let's hold size constant and just change share price, which is what happens after splits or reverse splits. Then we see a really big change in volatility and beta. So it's suggesting actually that price is what is fundamentally determining volatility and beta in the market.
Interesting. Any other empirical puzzles that can be addressed by this new understanding?
Recognizing that investors suffer from non-proportional thinking help us understand a host of puzzling features of the asset pricing data. For example, we can better explain the leverage effect puzzle. So this puzzle is about a really strong negative relation between past returns and future volatility. Now, what happens when past returns have been poor? Well, it just means the share price of a stock is lower than it used to be. And if investors are reacting to news in the same dollar units as they did before, but now the share price is lower, due to this negative return, then the volatility is going to be much higher. The other puzzles that non-proportional thinking can help us understand is this phenomenon of long-run and short-run reversals. So reversals are a fact, which is that past winners tend to underperform, and past losers tend to outperform. Previous returns tend to revert. Now, this could happen if, for example, for lower price stocks, investors overreact to news in dollar units. Well, eventually that mispricing should be corrected, which means those returns should move in the opposite direction after the initial reaction. And that's what we find again in the data. Long-run reversals as well as short-run reversals, they're very much driven by lower price stocks, holding size constant.
That makes a lot of sense. For the more practically oriented students of your work, what are some of the kind of things one can do to remedy this bias in oneself or take advantage of it in capital markets?
Well, to remedy it in oneself, one just has to be really careful to think in the right units. So even though we're constantly being exposed to media, tickers on CNBC showing dollar changes, we should always think, what does this mean in percents? We should try to find financial statements that show information in percents. It could also be remedied if media outlets and stock tracking apps actually showed returns rather than prices by default. I think that would help this bias go away. It's pretty similar to what happened recently when the Dow had the largest point drop in history. Now that's again a meaningless unit. It was not the largest point drop in percentage units. And also in terms of ways to possibly profit from this phenomenon, I am not a trader myself, so I can't speak about transaction costs. But simple ways to trade upon this are, if you're already betting on reversals, tilt it toward lower price stocks, because those are the stocks that drive reversals. The other way to bet on this is a pure volatility bet. So you could trade in the options market, basically buy straddles that pay off when realized volatility is higher than what's estimated by option traders. So that's another way to profit from this.
Great. You told us about non-proportional thinking. The fact that the level in dollar terms of a stock actually matters and it has implications for volatility, for beta. You talked to us about some of the relation to the small cap effect as well as mean reversion. Thank you so much. It was very interesting. For those who want to read more about your work, I think we're going to have a link to your paper on SSRN on this page. So thank you.
Thank you very much.